In today's market, a lot of people are thinking that healthcare REITs are going to be the driving force in the M&A market for seniors housing and care. And because of that, I'm here with Justin Hutchens. He's the president and COO of National Health Investors, a New York Stock Exchange REIT. Justin, most of NHI's investments are in senior housing and care. You've got over 80 nursing home investments, almost 30 assisted living investments. Where do you see the REIT investing in the next 12 to 18 months? Staying in that focus area?
We will. We have 90% of our revenue right now comes from our leased assets, and about 80% of that is from senior housing. We have a little bit larger percentage of skilled nursing. We're at about 69%, and that's actually down from a year ago. And the reason is we've diversified more into assisted living. So we'll continue to diversify into assisted living. We'll also look at other opportunities. We get a lot of credit as a REIT for diversification. Our investors want to invest in a high-quality, diversified portfolio. So as much as we like skilled nursing, we like senior housing in general, other assets that are opportunistic will also get our attention. An example would be an acute psychiatric hospital that we bought last year, and we actually closed on it earlier this year. It is, Medicare, HMO backed, no Medicaid, really strong coverage. It's based in San Diego, so very limited opportunity to compete with it. And it had a 12% yield, so that was a good opportunity for us to diversify.
That's a good yield in a good market. Do you have a target investment goal for the rest of, or for all of 2010, and then going forward into 2011, a dollar amount you'd like to do?
We did give guidance for the second half of 2010 of $30 million. 20 of that we've already put out. We don't actually have a goal that's based on volume, though. We're looking at investments on a per deal basis. We're looking for the combination of good credit and high yield and those assets that help our diversification. And we don't have a goal to become any certain size or to hit any certain volume of deals per year. We'll give an FFO guidance each year, and we'll factor in some amount of investments. Usually we're probably going to get ahead of that, but if we don't, that just means that the particular investments in our pipeline weren't right for us.
Right. And how about your yields, the initial yields for skilled nursing investments versus assisted living? Are they similar, or skilled nursing a little higher?
The skilled nursing does run higher. We feel comfortable we can get a 10% lease rate on a skilled nursing asset consistently. That hasn't really changed much even this year with the cost of capital from other sources dropping. 10% is still there for us. The assisted living, there is more competition there because like us, other REITs also want to diversify, and a lot of the healthcare REITs have a big skilled nursing holding, so they'll look at assisted living assets as well. And usually you'll see anywhere from 8.5% to 9.5% lease rates. We haven't done any below 9%, but the market is drifting down a bit.
How about your customer profile? I don't see you doing the large companies. Are you more the regional and mini regional type clients?
The advantage of having large companies, and the two that I would point out that are our tenants, is National Healthcare Corporation, which is our anchor tenant. They represent, their master lease represents 45% of our revenue. That's down from 60% a year ago.
And that's pretty much how NHI got its start.
That's right. They founded NHI in 1991. Right. They have very little to zero debt, $500 million of equity, real solid credit.
Yeah, oh yes.
They don't need us to grow, so I don't know that we'll do a lot more business with them on the ongoing basis. We did add Emeritus Senior Living as a tenant. They also have very strong credit, and they do grow. So it's very good to have them because there'll be opportunities that come our way just by virtue of doing business with them. But the really good operators are those that they're the regional size operators. We have a very high level of talent focused on a smaller number of buildings, and you can see it in the
Like
operating
Bickford.
metrics. Bickford Senior Living is a
Yep.
great example of that. They're a regional player that we've done 2 different transactions with, and they're a tenant of ours. They fulfill the credit side of the underwriting with their very strong operational track record. So we do enjoy working with the regional companies, but in the interest of diversification, you want to have good, strong credits. I don't lose sleep over, for 1 minute, Emeritus or NHC paying their lease payments with their credit and balance sheets. The regional operators have really good operations, and we feel really good about the potential with those. Even smaller companies as well. Having a blend of all of those is really where we want to be.
And I know earlier this year you did I think it was a $13.9 million construction loan on a skilled nursing rehab facility. Do you see yourselves doing more on the construction side because there's such a need for financing on that, or was that
Right.
kind of a special one-off transaction?
That was the start of what will become a construction program for us. We are interested in constructing. We like the newer assets, and we'll certainly fund construction where it puts us in a position to own assets. And what was unique about that is we negotiated the purchase option and actually fully negotiated a lease, so that when we do step in and buy the property, we're ready to turn around and lease it back to the operator at a mutually beneficial cap rate. They'll have strong cash flow, we'll have strong coverage.
And you'll have a beautiful new building.
Beautiful new building. And also assisted living as well. We'll look into funding some construction for assisted living. It's a great market. No one's doing it right now,
Right.
And so there's an opportunity to take advantage of certain markets that have a lot of demand and growing demand that could really benefit from new supply.
Okay. And I know a lot of your competitors in the REIT industry are diversifying into the medical office building space. Is that something you guys want to target, or you just want to stick to your knitting in senior housing and care?
We've told those that call us and offers MOB investments that if you can bring them at a 10 cap and they're on campus and they're guaranteed by the hospital, that we'll do them. And we haven't had any come our way. So it's just not, the yield's not quite where we want it. It's a lower risk investment. I think it's right.
Lower risk, lower yield.
Yeah,
and
and I think for certain players it's a really good investment. For us, it just doesn't quite fit our profile.
yeah, no, that makes sense. And you want to be able to support your dividend yield. Well, that's great. I hope you can get some more construction financing out there and get the word out, because there's definitely demand. So thanks for spending time with me.
Yeah, appreciate it. Thank you.
Okay.